First of all, the inflation, as I said, is not due to a war, but is due to central bank policies. And actually, in response to your main question, so let me set out how the policy needs to be structured to have high growth and no inflation. That is possible. We've seen it in many countries, particularly in East Asia, Japan, Taiwan, Korea, and China, that have achieved 15% economic growth, or between 10 and 15 for a decade, 2 decades, 3 decades. In the case of China, 4 decades. It's possible with very low inflation. As I explained earlier, the economy is driven by bank credit creation, and it's the allocation of bank credits that determines whether you're going to have high growth or high inflation, or both, or neither. If bank credit creation, and therefore bank loans, are mainly given for the purchase of ownership rights, property, financial assets, because bank lending is money creation that's newly added to the money supply. You are essentially printing money and buying assets. What will this do to asset prices? I think all of you know the answer. This will lead to asset inflation. This is when it happens, and banks do this a lot, they can do it for a long time. You get asset prices rising, property prices rising, real estate prices rising, people making money in this sector, but it's unsustainable because the loans have to be serviced and repaid, and essentially you're creating only capital gains, so it's unsustainable, will result in a banking crisis and a property crash and things like that. We've seen it many times. That's one scenario. That's if banks give loans for asset purchases. These, by the way, are not part of GDP because asset transactions are not contributing to value added. That's why the national income accountants do not include them in GDP. But if banks are encouraged to lend for transactions that actually contribute to GDP, which in East Asia they were by the central bank, that ensured that most bank credit was going for the real economy. And the central bank can easily do that if it wants to, if it chooses to do this. Then you will get higher nominal GDP growth as a result. Now we still have two possibilities though. If bank credit going for GDP transactions is mainly for consumption, because bank lending is money creation, you are giving newly created money for consumer spending. What will happen with consumer prices? They will rise. Consumer price inflation. That's also not good. That's of course what's been happening in many countries since 2020. But the third scenario is the redeeming feature of our monetary system, which is a monetary system based on banks being the creators and allocators of the money supply. Central banks only create 3% of the money supply. 97% of the money supply is created by the banks through bank lending. And when banks mainly lend to businesses, especially small firms, for productive business investment in the implementation of new ideas, new technologies for increasing productivity. You have money creation, increasing in the economy, injected through the banks, but at the same time you have the creation of new goods and services, higher value added being produced. You will have no reason for inflation. You get high growth and no inflation. So, if you want high growth and no inflation, it's easy. Just tell your central bank to do its job properly and ensure that bank credit by the banks is given to firms for productive business investment only. You will see massive boost to real economic growth, to employment, to incomes, to tax revenues, and no inflation, drastic drop in inflation. It can be done, has been done. But this is one of the secrets of the banking trade, and the central banks, of course, want to keep that secret. That's why they created the false propaganda of mainstream neoclassical economics. And oh no, let's talk about interest rates, which is complete red herring and distraction. So, Turkey can do this. We can have higher economic growth and lower inflation or even almost no inflation. And that's the policy combination that the central bank should be adopting. And those countries that have central banks that adopt this policy do see the benefits. Ironically, the Federal Reserve itself, of course, very much aware of this, has been taking much better policies than the other central banks that have to do what the Fed tells them to do, such as the Bank of Japan, which has had the most disastrous monetary policies in the last 40 years, really, of any central bank. But the Fed itself has ensured that bank credit for businesses is booming. America has many banks. The more banks you have, the easier it is through the system to get broad economic growth that is well distributed to small firms, and therefore inequality is low. That's the secret of having low inequality. Look at the banking system. If you're like the UK and you've only got 5 big banks, they want to lend to 5, the big banks want to lend to very large companies, because if you're a big bank, then you don't want to do any real hard work as a banker and kick the tires and check the books of small firms that want to borrow £20,000. You want to do big deals in the multi-millions, in the billions, and these are the private equity funds and hedge funds that engage in the asset investment. So you don't get the productive business investment, you get low growth and low productivity, which explains what's been happening in the UK, and high inequality, financial sector not contributing to value added, getting so much of resources allocated to it. But if you're a country that has thousands and thousands of small banks, then you get high growth. And if they lend mainly to small firms for business investment, you get low inflation. Essentially, this is what the Chinese leader Deng Xiaoping, when he came to power, realized in 1978, having come back from Japan and having found out how they did it. Double-digit growth, low inflation. And he realized, okay, the Soviet system of having very few banks is not a good one, or just one bank, which seems to be what many central banks want to do through their propagating central bank digital currencies, which will harm the small banks and will get rid of banks and leads to concentration. But Deng Xiaoping said, no, we don't want that. We want to create thousands of banks, and that's what he did. He established small banks, community banks, regional banks, savings banks, local banks, provincial banks. Now China has almost 5,000 banks, and they were lending mainly for productive business investment to small firms. You get the money creation going into this creation of new goods and services, adding value that delivers high economic growth, employment, job creation and tax revenues, but no inflation. That can be done, and that's the solution. And it's always the same story. Any country can do this at any time. And Turkey, I believe, as I said earlier, is in a very good position because of the political pressure from the US bloc. There's this creation of 2 trade blocs in the world. The BRICS countries, including Russia, China, and many others, is actually growing, that are doing an increasing risk trade, and Turkey is well positioned for that, while it's of course also well positioned to help out the declining and diminishing European economies that are being crushed under US imposed sanctions. Thank you very much.